Firstly, what is lender's mortgage insurance?
Yeah, this is an insurance that effectively covers the bank. Let me repeat that again. This is an insurance that covers the bank, so it doesn't even cover yourself, in which you actually pay for as a borrower.
The good thing is it allows you to buy a house when you've got less than a 20% deposit. The bad thing is it's a once-off fee that gets added on top of your loan, and it potentially remains with you until you pay off or for the life of the loan.
Now, the cost is determined by a number of things, such as the amount of deposit you've got, as well as the total loan amount. Today, we're going to run you through how to calculate that cost. So Jaden, let's jump in and look at the calculator.
So you can check out the lender's mortgage insurance calculator on our website, huntergallery.com.au/LMI-calculator. We'll include it in the link below. This calculator can be used for anyone across Australia. It's not just Queensland specific. So let's start from the top. Say you've got a 10% deposit. So you're going to put in $100,000 on $1 million purchase. The bank's going to give you a $900,000 loan. The lender's mortgage insurance costs $23,000 in that case.
And just remember, in this scenario, although you're putting down $100,000 deposit, remember there's still government fees and charges such as stamp duty, your solicitors, and everything else that you'll need to pay on top of that $100,000 that we put in this example.
Again, if you want to check out the stamp duty costs, you can check out our calculator here. It's got all the different states. So if you're in New South Wales, you can work it out. Because in that case, you're going to need your $100,000, your 10%, plus another $40,000 to cover your whole deposit.
And keeping in mind that solicitor and building and pest or building inspections you're going to be doing on top, give yourself a little bit of a buffer for that as well.
So back on the calculator, if you're looking at putting, say, the minimum deposit, you might not have 10%, you might only have a 9% deposit. So you go to $91,000. It's amazing to see the mortgage insurance jumped up almost $16,000. It's pretty huge to $36,000 overall.
That's right. So as we can see in this example here, the mortgage insurance is determined on a sliding scale. The less deposit you have, the more expensive the cost is.
From what we find, a lot of times the sweet spot is either sort of a 10% or a 12% deposit because it actually drops quite dramatically. If you have an 11%, oddly, it doesn't really make a difference. So if you can see the calculator here, again, back to the 10% deposit example, you're gonna need $23,000 in mortgage insurance costs that's added to the loan. But if you can get to the 12% deposit, the mortgage insurance drops down to around $15,000. So it can be quite a big savings. You're gonna need a bit more in deposit there. So it's kind of working out if you've got another $20,000 in your back pocket. It's not always that easy, but it can help save a bit of cash.
Now keep in mind, if you've previously paid mortgage insurance and you're doing a renovation on your home and you're still with the same bank, the insurance you've previously paid is credited. So if you've paid 15 grand last time, you're lending back up and the new insurance premium is 20 grand, you actually only pay the difference between what you've paid and the new premium. So something to keep in mind, because if you are changing banks, that premium will be charged 100%. There's no credits, so the insurance is non-transferable between the banks.
It's also a similar story if you sell a property. It used to be the case where the banks would sometimes refund you the mortgage insurance if you sold within 12 or 6 months. Unfortunately, it's changed, and in general now, in the case of nearly all the lenders, you pay the mortgage insurance and there's no refunds at all.